who is potentially looking to raise in the next like 6 to 12 months? That's a lot. If you're anything like me, you're a little terrified of the market right now for fundraising. Unless you're one of the AI companies that has like 10 million in revenue in the past 6 hours, that's great. For most of us, it's kind of a weird time right now, which I feel like we've been saying for like 5 years, but it's still weird for sure. So I want to pull this panel together of 3 awesome, very helpful people that have been amazing in my life, but also can be really helpful for yours. So we're going to be talking about fundraising, getting funding even if it's not like through the VC path, and then also what a successful exit can look like if you're not on track to being like a $1 billion IPO or something, or $10 billion IPO. I feel like that's what people are talking about now. What can that look like? Trillion? Yeah, I mean, yeah. Okay, feel free to take your seats. Okay, so, oh yes, sorry, thank you. Thank you for the reminder here. Okay, so these 2 here on my right, I'm going to introduce them individually in a second, but they come from these 2 companies, Goodwin, the Goodwin Procter legal firm, as well as Rizoma. Amazing sponsors. Thank you again for sponsoring this. 2 years in a row from Rizoma and 3 years from Goodwin. So thank you so much for making this possible. Yeah, they have great offers here. So if you want a 30-minute legal session with Goodwin, I used that like 2.5 years ago, and I've been working with them ever since. Then email Patterson@Goodwin Law. That might be a little bit small if you don't zoom in on your camera. We'll definitely send a lot of this information out afterwards. And then Rizoma we'll get more into in a second. But in short, M&A advisory. And so they're going to be having taking part of the Climate Founder Summit tomorrow at 9:00. So if you scan that QR code, you can sign up there. Anything else you want me to say about that? Great. Okay. Last thing, can people hear me? I feel like I couldn't hear super well on the last thing, but I also ruptured an eardrum recently, so maybe that's just me. Okay, just raise your hand if you hear. All right, to actually dive into it, you already know who I am. This is Claire Veuthey. She's a managing partner, right? At Rizoma Advisors, like I just said, M&A advisory. We'll dive deep into what that really means in the session. Dane Patterson, incredible lawyer at Goodwin. He's helped me through 15 different types of things, so kind of anything related to really anything you need as a founder, he's going to be great for. But in particular here, M&A. And then Shaun Abrahamson from Third Sphere VC, who is invested in like half of this room. So this is coincidentally just a great showcase of Third Sphere.
My partner's invested. I just showed up to take credit.
Well, it's great. So, all right, to actually dive in, first let's talk about what does fundraising look like right now from the typical VC path. I think everybody knows what fundraising used to look like generally, but what's going on out there right now? Let's set that stage. We'll look at you, Mr. VC.
Like I know. I have no idea. I gotta say, so I think I did my first investment a little bit over 20 years ago as an angel investor. And right now, I understand the Series A process less than I ever have. So, I mean, some of that is obvious because you alluded to like, hey, how do you get to $1 trillion and why aren't you, growing at sort of 100% an hour compared to all the AI companies? And so I think what's happened is most VCs have been given the green light to gamble. Like they can just go all in as long as you can point to growth and you can say AI and physical AI and data center and energy. If you can't say those things, I don't think you have permission to invest. That's our read. And so we've just spent a lot of time trying to help companies. I think Amir made the point is like, let's see if we can sell something in 3 months and get back to work. Like that is I think that should be the default, right? Like figure out, spend the time with customers. And so in a lot of ways, fundraising from a traditional venture, we've said Series A is plan B, and plan A is get to break even and explore other funding options, which would be, I won't spoil things and we'll get to that.
Great. Okay, so if Series
very
A...
upbeat.
I love this. I also love preparing for this because it's kind of like, hey, everything's really tough and scary. How do we not just say everything's tough and scary? So yeah, okay, if Series A...
Now that that's out the way.
If Series A is plan B, how do you advise companies, either in your portfolio or even people just coming to try to pitch you, how do you advise people to operate these days?
I think instead of trying to sort of understand what VCs want, just figure out what customers want. There's a bunch of ways to get them what they want more quickly. Some of that involves using AI. I think the most surprising thing for us, I think Pat's here and Lily from Swell Cycle, is you can go faster than you think. And again, Amir made the point, like, yes, you could do one more iteration. Where's Raj? Raj is the iteration. Let's do V4, like major anxiety. Don't do that. But I think you can always go faster. I mean, in truth, like they got a product into the world that I think they were embarrassed about, and that's the way, right? Like sell the thing that you're embarrassed about, because the reality is like your customers, if they've said yes, like you're the best option, even if you can imagine a much better option. I think that's where a lot of founders get stuck, is you're overbuilding because you can see what's in the future. Most people that you're selling to can't imagine that. They're just like super happy with the thing you just demoed. So sell that to them. And I think that's probably the biggest change. It's sort of a mental shift to give yourself permission to sell faster. And then VCs like us become irrelevant, which is what we should be.
If I can pick up on that, in an M&A environment, we've seen getting to break even be extremely valuable, right? You wrest back control to some extent. There's a company we worked with about a year ago that thought about raising another round or selling, and it's always like at the right price, but then they cut the team down a little, the founders took back some of the work, and we helped them through an M&A process that worked out really well for them, but they were able to do that because they didn't have to sell. They had maintained some optionality in a way that they wouldn't have had if they'd kept their whole team and the burn that they had before.
And that, to add on that optionality really helps when you're in those discussions with a sales scenario. When the buyer knows you have to sell, that's often a very different number you get or dynamic than if you don't have to sell or you're choosing, you can kind of write your own destiny. So easier said than done, but especially in the M&A context, that's really important.
Definitely. Yeah, I mean, revenue solves all problems for sure. Like, I feel like that's always been the slogan, but I also feel like we kind of forgot that for at least a few years. Okay, so if let's say you're not quite able to hit break even, and you're also not going to raise from VC, what are other forms of funding? Especially, I mean, in the climate space, grants were talked about a lot. For like the last year and a half, that's been pretty hurt. So yeah, what's the non-VC funding route look like these days?
I mean, so there's probably a few options. The one that we spent a lot of time on, my partner Miela is here, who just shipped something called creditdb.ai. We put AI in it so everyone would immediately think it was important, but all it is a way to find non-dilutive funding. So it turns out there is actually a lot of products like in the SVB building we can say venture debt, right? Everyone knows what that is. It's very clever naming. It's a little bit like the inverse of heat pumps, right? You kind of know what it does, except you're wrong. The best types of debt tend to be things that are like asset-backed, right? So you have an asset, and that's the thing. You can lease a heat pump, or project finance, or we have off-takes that people are essentially buying in the future. And actually, like we have 300 of these things, and I wouldn't say we haven't tried, but there are a lot more. And they are totally underexplored, right? When we looked at this a couple of years ago, if you did research on debt and you looked at, let's say, YC as a reference for founder education, there were two blogs from YC. The one was venture debt is a shit sandwich. It was Paul Graham, and I think that's exactly what he said. So in other words, don't do it, in case it wasn't clear. And the other is venture debt. Here's how it works. So in other words, like nothing else about lending at all. So that would be the first thing. And then I think the second thing is, especially for climate teams that are working with physical products, and I think we've heard from a bunch today, your suppliers and your distribution partners are often also your bank. And that's not always clear, right? But if they're willing to extend you terms, they are your bank. And they're very well aligned. So, sometimes I think we don't ask enough of the sort of large logo, super well-known supplier or distribution partner. And that's sometimes a really good place to actually explore essentially funding or cash flow options.
Yeah, those are really good points. And I'd add, if you're a little caught up in kind of the venture fundraising game, it can be the growth of spend and burn can really get away quickly. And so I think if you are in an environment where that isn't necessarily going to be there, then I think you have to manage your growth or spend accordingly, maybe different than if you were really confident that, hey, in 6 months there's going to be a Series A round. You really have to be thoughtful about that.
I want to step in for Toys here. Also, I meant to mention, I like having, especially sessions like this, more interactive, and like we're going through several different topics. So if you have any questions that pop up related to what we're talking about right now, feel free to raise your hands, if that's all right. I think it's great not to have to wait till the end. So yeah, just raise your hands. I'll keep looking around. But I think that makes a lot of sense. I never even looked at venture debt. But I also think like framing the customer contracts as kind of a bank, and your point of it being super aligned makes a lot of sense. Does that make you look at these companies as more traditional businesses rather than startups to some degree? I feel like a lot of the story around a startup is like, here's an idea, we got a customer, we raised $10 million, we burned that as fast as we could to see how far out of the stratosphere we could go. And if it worked, then we made it to Mars, and if it didn't, then now I'm going on to something else. But this is a different approach, where it's like, well, let's actually try to be more level about how we spend money, how we get that growth, et cetera, because we can't count on an infusion of $5 more million. Are you advising teams in kind of a different way? Do you think these types of companies look different because of that? Do these business models change?
That's what we were talking about. I think AI has changed it a lot for companies. I've talked to a couple founders, execs recently who have unfortunately gone through a couple of rifts, but it hasn't touched their top line because they're able to automate the rest, or they've managed to AI their way out of a lot of it. It's still pretty new, so we'll see if they can maintain it, but they seem to think they will. That's not a new form of capital, but it is a way of keeping your business afloat. I feel like, venture is, and people say this a lot, right? It's rocket fuel. If you're not on a rocket, it's not going to work. Like it's, sometimes we forget that the point of the business, or at least part of the point of the business, is to make money. So the faster you can get to above zero, the better it is.
It's not just about raising more money. But the goal of the aim is good to be.
I think we've lost. I think VC's done a really good job of using up a lot of the attention for how to build companies, and it's really just one way, and it's probably the right way if you build certain types of software companies. It's not the right way for most other stuff, and it has never been. Right? There's no proof that mega funds figured out something new about company building. Literally, there is no data that supports that. Maybe they're going to be right about 25 to maybe a third of how companies are built. But even if you look at IPO pipelines, like a lot of the stuff that gets to IPO is like partially bootstrapped. I mean, it's not venture. These are not like very smart VCs who went and picked all the IPO candidates. It's just not reality. And we've been like, since we started investing, it was very funny. Like, I had a sort of small cohort of co-investors as long as I was an angel investor, and we mainly did software, right? So like, ZocDoc was one of my first investments. Like accidentally landed up investing in Blue Bottle, like literally accidentally, with a whole bunch of other VCs who couldn't understand how they wound up there. But as soon as we started to work on climate, we were like, we're going to do hardware. VCs are like, oh, that doesn't work. Yeah, we can't do that. Like, it's not even, like, literally there are people building successful hardware companies. The top tech companies in the world are mostly hardware companies. How did we get to believe that VCs know everything about company building if they didn't do any hardware? And incidentally, that changed recently, because now all VCs want to do hardware. So, like, literally, these are not people you want to listen to, and I will include myself. Like, I don't know more. Like, you know your customer, you can go and figure out a customer. What are you asking me about, right? Like, go and get more customers.
Yeah. Okay, one thing that I keep hearing about, I've worked on myself, the company that I sold Thresh to is a services company. One thing I keep hearing is services, and how that used to be kind of a dirty word in the tech startup space because of how that scales, and now that's flipping on its head. What are we seeing out there related to services? What does that mean in the industry today?
I think for the last couple of years, until quite recently, services was a bit of a dirty word, or at least certainly part of the diligence we'd see in buyers diligencing the sellers we were representing. They wanted to understand how much was like the services revenue being hidden, right, or disguised as something. Like, is there actually more services here, or is it a pure SaaS company? Over the last couple of years, we've seen companies that started as SaaS companies buy or build services teams and business units. So I think there was a bit of, there's a fair bit of climate tech, or at least has been over the last couple of years, that meant to like replace consultants. I don't think that's happened, by the way. I think people still want like a trusted human relationship. I do think tech can help consultants be more efficient, so there's a plus there, but I don't think you're gonna like completely get rid of EPCs and KPMG. And I think there's the beginning of a realization there that they're either excellent channel partners, and in some cases can be acquired. We've seen, I think we were talking about this earlier, one of my partner's missions in life is to sell a tech company to an EPC. It sounds a little crazy because the business model mismatch is real, but we've also seen some EPCs be quite interested and open to buying tech to integrate into their own work. Sorry, and what is it?
Engineering, procurement,
and construction. Yeah, like big engineering consulting firms, which have broadened into, you have environmental services firms like straight management consulting. There's kind of hybrids now, but by and large, services firms as a high level. And I heard recently about a core services firm. It's like a sustainability consulting strategy firm that got an LOI from a SaaS company. I'd never heard of that, but I'm seeing that more and more. So it's kind of interesting, this like business model mix, and seeing how the software can improve the service or help grow or whatever it is in a way that wasn't really contemplated before.
And you just said a services company got an acquisition offer from a SaaS company?
Yeah.
Okay.
Yeah.
And then I don't know how much you're able to share. Right? Was that like to combine their offering and be able to AIFI the service?
Yeah, that's
okay.
right. Yeah, exactly.
Yeah. That's definitely happening a lot.
I don't know about a lot. I've certainly seen bits of it, and I feel like it may be emerging to a trend. Like, let's talk next year, but certainly seen more of it over the last 6 months than I would have expected. We also have worked with a company that started out as a core SaaS company, built up a kind of, like, I think it started as their customer support, and it's become a consulting arm, and they're interested in growing the consulting part of their company as well. So they see it creating a kind of virtuous circle, if you will, between their various software products and the consulting that helps support people and helps their customers get more out of the product.
Dane and Shaun, have either of you seen a team that has a SaaS product but then adds in a services component and kind of grows that business? I'm curious, like, how do people do that right? How do people do that wrong?
I mean, I see the service piece of it. The clients that I work with, it's kind of a necessary part of, the SaaS business, but I haven't really seen them like lean into that really hard. Just because I think what we're all talking about, historically they were able to get, valuation multiples on their ARR, at a much higher clip than services revenue. Hopefully, maybe that's changing in certain places, but I think, they're still focused on the recurring revenue in my clients.
Yeah, I mean, I think, the best climate policy recently was, shutting down oil in the Middle East. It's like unintentionally probably very good. And AI is probably eating enough of SaaS multiples. I think our default assumption for SaaS was like 10x trailing 12 months of revenue. It's probably like 4 now. So there's nothing like a valuation haircut. But there's nothing like it to sort of make you think about alternatives. And so that is one of the sort of good things that I think has happened, at least opens the door. I don't know that services companies can match or replace the sort of SaaS valuation or make them that much more attractive than software companies, but it's definitely a discussion, and there are founders who've pivoted into that for a whole bunch of reasons. In our portfolio, Cove was building a automated, essentially LCA analysis for architects. And about 18 months ago, they sort of got the sense that there weren't as many architects who were really interested in sustainability. And one way that you can tell is like, yeah, you could license in, but then you would ask about who else is being trained on the tool. And the answer was, yeah, we have contractors, or we're not really investing in new hires for this. And so that was their sort of blinky light to say, oh, this is probably not a way to keep growing. And in their case, like, we aren't going to have the LCA type of impact that we'd like to have in architecture. So they did a test, and they just said, they worked with a partner firm, and they said, we will help you sell architecture services, and we'll just go back to being an architecture firm, which in their case is when we met them, that's what they were doing. They were an architecture firm with some scripts that became a software company. And now they've gone back to becoming an architecture firm. And I think what they found is, you're not selling to architects anymore. You're selling to developers, which is a whole new customer segment. But a lot of the architects actually hated the work that is getting automated. Like it was like trying to figure out if you're meeting code compliance. Like everyone's looking around hoping that someone else is going to do that grind. So it's still TBD. I don't know what the valuation, like they haven't been back to market to raise. So yeah, still TBD, but definitely the like SaaS apocalypse, I think, is the proper term, has helped to at least open minds to the possibility that services can work.
Really, I mean, what you just said of people hate this part of the job, and then you say, great, I have a great solution that automates this for them, and then they're like, okay, and then they kind of trail off in some way. It's so painful. that was a lot of what sales has been like for Thresh, I think we're gonna have a lot more of those types of services where it's like, look, we just take care of the whole thing. We don't have to like convince you on a piece that becomes software or whatever, but definitely curious to see more where that goes. We've got like 3 minutes left. Again, please feel free to ask questions, but I do want to touch on exits. Over the past few years as a founder, I did not really think about exits too much because I was kind of focused on entrance. but there's actually a lot to learn from all this, which I mean, I got a lot of information from you in particular on that. Yeah, I guess my first question is to you, Claire, like, what do you wish everybody in, let's call it seed stage, could know about what an exit could look like if it's not like an IPO type of thing?
I think especially for a lot of climate tech, an acquisition by a strategic is actually a very good and sensible option. Valuation we can discuss, right? There's been some beautiful ones and some less beautiful ones, but
would that be like one of your customers or one of the kind of competitors? What, like, define strategic in that sense?
oh, I mean like the really big global conglomerates that
Gotcha.
are like selling to Siemens or Bosch, right? I think lately there's been more, given the contraction in VC funding, the higher kind of bar that everyone has to hit to even think about raising, we've seen more consolidation, right? So slightly better capitalized startups buying an immediate competitor or a partner, in a way that, you know, I think investors, and maybe Shaun can speak to this, like sometimes are willing to roll equity, right, and like keep going with the next one. Not always. That's not the investor and or the founder that they originally invested in, but sometimes that makes sense for them. I'd say think about it earlier than you think you need to, right? We have folks come to us with like 8 weeks of runway, and there's not much we can do in that case. For a full process, we generally say 6 months, which probably means you need to be thinking about it like a year ahead of time. And then there's a couple of bits and pieces that we discussed I'm happy to talk about, of like the sort of one-way doors that when you get to an exit become really important, but you might not think about beforehand. So a requirement for a customer, for example, to consent to a possible acquisition of your company, or to give consent, or to have the right to cancel their subscription for any reason. This is like, it feels like a relatively small legal term, but it certainly can blow up deals down the line. We've seen a few get pretty close.
Yeah, no, definitely. I'd love to go a lot deeper into this, but yeah, we are at time.
Yeah.
But no, definitely, I mean, double click on that. Like, there are so many different small things that you're really not thinking about when you're making those sales, because you're kind of just like, please just sign the contract, send it back to me. I just need like a second customer or whatever it is. But yeah, I mean, if I had talked to you 2 years ago, there are definitely things I would have changed about the contracts that I had. And I mean, a lot of the things that could have been really scary were actually taken care of because we used the contracts that Dane gave us. But yeah, I mean, definitely take the 30-minute consult, talk to Claire, sign up for that event. I think we had one question here. Was that?
Yes.
Yeah?
How much is there about how the company is set up that should deal with the exit, like how the founders are, you know, set up their founding agreement and all that? Should that, is that all standard, or?
I mean, I'd say hopefully you have relatively standard, you know, equity agreements. You know, it can, if you don't, it can add a lot of complexity, but usually there's, you know, a clear path of, you know, have you raise money from investors? Usually if you're not clearing their preference, they're going to get their money back first, and then it flows to the common stock, which normally a founder would have, along with any other employees. If it's a really home run acquisition, usually the investors are going to get paid out pro rata on their ownership and not just get their money back. But usually the equity documents are pretty straightforward. Sometimes you have vesting acceleration in there. You know, usually that's only if you get hired by the acquirer and then terminated, but there's some other flavors of that. So usually, you know, you need the buyer first to buy the company, but usually the equity documents, if they're set up right, they just are what they are. There's some nuances though. If you've kind of gone non-traditional in certain things you set up, a buyer could say, hey, that's great, your agreement says that, but I want to treat the equity this way. If you have, you know, your 10%, all your employees are 10% vested, but you have a provision that says they all fully accelerate. So yeah, it depends.
Great. Okay, we're a couple minutes past, so I don't want to ruin the rest of the schedule. But thank you so much, all three of you. As I said, you've been great help for us.
Thank you. We have a treat for you as the last session because we know it's been a long day. But how many times can you go and feel like you're in Mad Men, right?